I want you to just picture a standard economic crash for a second. Close your eyes and really think about it. What do you see? Usually the script we get is pretty simple. We run out of something, right? We run out of oil, we run out of houses, or, I mean, most commonly we just run out of money. It is a crisis of scarcity. You get those panic lines at the bank, empty shelves, that sort of thing.
Right, yeah. That is basically the entire history of the 20th century in a nutshell.
Yeah.
Systems breaking down simply because the tank went dry.
But I've been reading through this massive stack of reports and articles you sent over for today. We're looking at everything from Dutch tax law to high-frequency trading algorithms. And there is a really weird unifying theme here that is, well, it's actually the exact opposite of scarcity.
Yeah, it's efficiency.
It's hyper-efficiency. We are looking at a world where AI makes labor so incredibly efficient that it might actually break the banking system, where tax authorities try to be so precise with things like unrealized gains that they literally crash their own IT infrastructure. And where trading algorithms are, they're so good at spotting patterns that they might effectively be price-fixing global assets like Bitcoin.
It is the ultimate too much of a good thing crisis. And specifically, I mean, it's about what happens when the digital world, to the algorithms, the tax codes, the paper contracts, when all of that moves faster than our physical reality can actually keep up.
So we have a monster deep dive for you today. I'm your host, and I'm joined, as always, by our resident financial expert. We are targeting 3 main pillars based on the source material today, including some really fascinating reporting from financial analyst Madelon Vos. First up is what we're calling the policy trap. We're going to look closely at the Netherlands. And before you tune out thinking, Dutch taxes, how boring this is, actually a terrifying case study in how a modern Western government can accidentally decapitate its own startup sector just because their computers are too old.
I know it sounds like a joke, but it is a massive warning shot for the rest of the world. It's really a story about capital flight.
Exactly. Then second, we've got the AI paradox. We're going to walk through this wild theory from a Sint Trinity research report. It suggests that 2028 is the year the credit system breaks. And not because companies go bust, but because you and me, the humans, just aren't needed to work for them anymore.
And if you don't have wages, you don't have collateral. That is the key mechanism we really need to unpack today.
We'll definitely get into that. And finally, the third pillar, the hidden hands. We have got to talk about Jane Street, these shadow maneuvers happening in the crypto markets, and why a country as big as India is suddenly deciding it just doesn't trust London's gold price anymore. Yeah, that last one is a geopolitical earthquake. Almost nobody in the mainstream is reporting on it, but it is a massive shift from paper pricing to physical pricing.
So if we had to slap a clear mission statement on this deep dive, what would you say it is?
I'd say our mission is to trace the cracks, because the system looks really stable on the surface right now, right? Stocks are high, tech is absolutely booming, but underneath, the plumbing is leaking. We need to show you where those leaks are so you don't get swept away when the pipe finally bursts.
Let's just dive right in. Pillar 1, the policy trap. We are zooming in on the Netherlands. Now, I will be totally honest, when I saw Dutch Box 3 tax reform at the top of the pile of sources, I almost completely skipped it. Why does a listener sitting in New York or London or Singapore care about how Amsterdam taxes a savings account?
Because the Netherlands is the ultimate canary in the coal mine here.
Okay.
You have to remember, this is the country that effectively invented the stock market. They invented the Dutch East India Company. They are the historical birthplace of modern capitalism. So if they can screw this up, literally anyone can.
Okay, fair point. So set the scene for us. What exactly is this Box 3 controversy?
So in the Dutch tax system, they separate things into these different boxes. Box 1 is just your regular job income, your salary. Box 2 is if you own a substantial chunk of a company. And then Box 3 is your savings and your investments. Now, for a really long time, the Dutch government didn't want to hassle people or themselves, honestly, by asking, how much exactly did your stock portfolio grow this year?
Yeah.
Did you sell? Did you hold?
Because doing that is a complete paperwork nightmare. Tracking every single dividend, every trade, every fee across millions of citizens.
Right, exactly. So they use what they called a fictitious return. They basically just assumed. They said, look, we assume you made, let's say, a 4% profit on your money across the board, so we will just tax you 30% on that imaginary 4%.
Okay, so it's a flat tax based on an assumption. Meaning, if I'm a savvy investor and I actually made 10%, I win, because I am only getting taxed as if I made 4%. But if the market is down and I only made 1%...
then you lose. You are paying tax on profit you absolutely never made. And For years, nobody really cared about this because interest rates were sitting at 5 or 6% anyway. But then 2008 happens, interest rates eventually drop down to zero. Suddenly, people have savings accounts that are earning maybe 0.1%, but the government is still taxing them as if they made that solid 4%.
So they are literally taxing imaginary money. That feels, I mean, is that even legal?
It's not.
Yeah.
And the Dutch Supreme Court finally stepped in and said exactly that. They ruled that this is a violation of property rights. You can only tax actual returns, not made-up ones.
Which brings us to today. The current finance minister, Ilkka Heinonen, is trying to fix this mess. But this is where the story gets incredibly stupid based on the reporting. You would think the solution is simple, right? Just say, okay, tell us what you actually made this year and we'll tax that.
You would think that.
Yeah.
But the finance minister recently had to admit that the counterproposal, this new law to tax actual returns that get it, cannot be implemented. He effectively went on record saying, we know the current system is illegal, but we cannot build the new one until at least 2027 or 2028.
Wait, why though? Is the math just too hard for them?
No, it's the IT systems. The computers are too old. This is that administrative reality we talked about in the intro. The Dutch banks and the tax authority basically came back to the government and said, our computers still run on batch processes from the 1980s. We can see your account balance on January 1st, and we can see it on December 31st. We absolutely cannot see every single trade, every dividend, and every cost basis that happens in between.
That is just mind-blowing to me. A modern Western government is effectively being held hostage by legacy code. COBOL is preventing national tax reform.
It really is a computer says no moment, but on a massive national scale. So because they can't physically tax actual returns, they are pivoting to something that is even scarier for entrepreneurs. They are proposing a capital growth tax on unrealized gains. In Dutch, it's the Vermogens St. Jones was belasting.
Okay, let's stop right there. Unrealized gains. This is the exact phrase that terrifies Silicon Valley, and frankly, anyone with an investment account. Define that clearly for the listener who maybe doesn't run a hedge fund.
Sure. So imagine you buy a rare vintage comic book for $100. A year later, a similar one sells on eBay for $1,000. On paper, you have a $900 gain. But you haven't actually sold the comic book. You still just have a piece of paper in a plastic sleeve sitting on your desk. You don't have the cash.
But the government wants to tax me on that $900 right now.
Precisely. They want a cut of the value increase, even though the money is not in your pocket. Now, scale that concept up. Imagine you start a tech company in Amsterdam. You spend 5 years eating ramen noodles, coding in a basement. You have zero salary. You own 100% of the shares. Suddenly, a VC firm comes in and says, hey, great app. We think your company is worth 100 million euros.
Wow, okay, so I am a paper millionaire. Time to pop the champagne.
We'll put the cork back in. Because under this new proposal, the government looks at you and says, hey there, your net worth just went from 0 to 100 million. You owe us roughly 30% tax on that gain. Right now.
Are you kidding? I owe 30 million euros. But I have $400 in my checking account. All my wealth is entirely locked up in the company shares.
Exactly. So what do you have to do? You literally have to sell a third of your own company just to pay the tax bill to the government before you have even really started operations at scale. You lose control of your own business immediately.
Well, it sounds like it would just kill every single startup in the crib. Why would anyone ever start a company there under those rules?
They wouldn't. And that is exactly the unicorn problem that is highlighted in our sources. We have founders in the Netherlands right now publicly saying, if this passes, I am leaving tonight. I'm taking my business elsewhere.
And it's not just bluster from, angry tech bros. Prince Constantine, the actual brother of the king who runs the tech startup Envoy there, he came out and publicly said, the signal we are sending is that the Netherlands is closed for business. When the royal family is publicly dunking on your tax policy, you know it's really bad.
Yeah, and the Washington Post even picked this up. They compared it to Norway. Norway actually tried a similar wealth tax recently. They thought, hey, we will just squeeze the rich. Do you know what happened?
I assume the rich just hired much better accountants.
No, they just left. The billionaires literally packed up and moved to Switzerland. And the tax revenue that Norway lost, because those people left to states, lost income tax, lost consumption tax, lost corporate tax, all of that was higher than the revenue they actually gained from the new wealth tax. It was a massive net loss for the state.
It's the Laffer curve in real time. You squeeze the bar of soap too hard and it just shoots right out of your hand.
And the real tragedy here, as the Washington Post pointed out, is that the Netherlands is actively destroying a culture of capital that took them 400 years to build, all because their computers are too old to process a fair tax system.
It really highlights just how fragile these modern economies are. We always think of them as these robust, unbreakable machines, but sometimes it is literally just three guys in an Excel spreadsheet holding the whole thing together.
And speaking of fragile machines, this utter incompetence in collecting tax is really only matched by their incompetence in spending it.
Oh, you are talking about the black hole in the EU budget from the notes.
I am. Because if you are a Dutch citizen being aggressively squeezed for every single penny of unrealized gain, it might sting quite a bit to learn that 10.7 billion euros of EU funds just vanished.
Wait, walk me through that number, 10.7 billion. You can't just lose that under the couch cushions.
The official bureaucratic term they use is faulty or dubious payments. That represents a massive error rate of 5.6%. Essentially, the money was sent out, but the documentation is missing or went to the wrong project or it just disappeared into the ether, completely unaccounted for.
So let me get this straight. They are frantically trying to raise maybe 4 or 5 billion from everyday savers with this Box 3 tax, creating a massive nationwide panic, while simultaneously losing double that amount through sheer administrative incompetence at the EU level.
Puts the whole fairness argument they use into a very different light, doesn't it? And it's not just the EU. The Dutch defense spending is another prime example in our source material. The Central Planning Bureau, the CPB, is warning of absolute billions in waste right there, too.
This one is deeply ironic to me. Usually the military is always complaining they don't have enough money. Here you're saying they have too much.
Well, they got a massive budget increase recently due to all the geopolitical tensions, but the bureaucratic system is so clogged up that they physically cannot spend the money. They estimate that 1.4 billion won't even be spent by 2030.
So the money just sits there in an account, rotting away due to inflation.
It's actually worse than that.
Yeah.
Because every single country right now is rushing to buy tanks and drones at the exact same time. The prices are skyrocketing. So the Dutch military is paying way more to get way less and leaving billions totally unspent simply because their procurement office can't process the forms fast enough.
It's a crisis of management at every level, and we see this exact same unintended consequence loop happening in the housing market there, too. The Affordable Rent Act, pushed by Hugo de Jonge, I feel like we see this exact story everywhere. The government tries to fix rent prices, and it completely backfires.
Yeah, it's classic economic theory colliding with political reality. The goal was noble enough, right? Regulate rent prices to make housing more affordable for everyday tenants. But they completely ignored the landlord's incentive structure.
Which is pretty basic. I need to make a profit, or I am not playing the game.
Exactly. When the new regulations hit, the investors crunched the numbers and realized, I can't make a return on this property anymore with these rent caps.
Yeah.
So did they just lower the rent and take the hit? No, they sold the house.
The stat here is crazy. 1 in 6 homes sold recently was a former rental property.
And who buys those homes? Usually it's owner-occupiers, people who actually want to live in them. And that's fine for them, of course. But it means that that specific rental unit is removed from the market forever. The total supply of rental homes shrank dramatically.
So if I am a college student or a low-income worker looking for a place to rent, my options just got severely cut.
Precisely. The law that was specifically designed to help tenants actually reduced the number of homes available to those very same tenants.
Okay, so we have a really clear backdrop here for Pillar 1. Government inefficiency, policy backfires, and massive capital flight. That is the local structural rot. But now, let's pivot to our second pillar. Because if you think local tax policy is disruptive, wait until you hear what Trinity Research is predicting for 2028.
Yeah, this is where we shift from these local governmental headaches to a global existential threat. The report is titled, The Global Intelligence Crisis.
The global intelligence crisis, that makes it sound like we all just get stupider.
In a way, the economy gets stupider. Or rather, the economy breaks because it gets too smart. The core argument here completely flips our traditional understanding of economics on its head.
Right, because we established in the intro that crises are usually caused by shortages.
Yes, but the Trinity report argues that the next great financial crisis will be caused by efficiency, specifically AI efficiency.
Walk us through the actual mechanism here. Because on the surface, how does a company becoming more efficient crash a bank?
Okay, think about the core banking business model. How do banks actually make their money?
They lend money. Mortgages, car loans, credit cards.
And what do they lend against? What is the actual collateral for the vast majority of consumer loans in the world?
My house. Or my car.
No, those are just the assets. The actual collateral, the thing that allows you to pay that monthly bill, is your income, your wages. When you walk into a bank for a loan, they check your pay stub first. The entire global credit system, which is trillions of dollars, is built entirely on the assumption that humans will have steady recurring income.
Oh, wow. I see where this is going now.
Right. So if AI allows companies to produce all their goods and services without needing humans, what happens?
Well, corporate profits go absolutely through the roof. They don't have a massive payroll dragging them down anymore.
Correct. The companies become insanely efficient, their margins explode. But the humans lose their income. And if humans lose their income, they can't pay their mortgages.
And if they can't pay their mortgages?
The banks become insolvent. It creates this massive paradox. The economy, if you measure it by corporate output and stock prices, is booming. But the financial system, measured by credit solvency, completely collapses.
So the bank is sitting there holding a 30-year mortgage contract that says, pay me $2,000 a month. But the person who signed that contract has been replaced by a software script that costs the company $2 a month. And obviously the software doesn't pay the mortgage.
Exactly. You cannot index a human mortgage to software productivity. The historical link between human labor and economic value is completely severed. And the Sin Trinity report pinpoints the year 2028 as the year this disconnect becomes totally critical.
That is terrifyingly soon. That's right around the corner. And the source notes mention that when this report started circulating, Wall Street actually reacted to it.
They did. We saw significant dips in major tech stocks. IBM went down 13%, and CrowdStrike dropped 9%.
Which is so ironic, right? These are the exact companies selling the AI. They should be the ultimate winners in that scenario.
They should be. But the market is always forward-looking. Investors are starting to do the math and ask, wait a minute, if IBM replaces all the workers across the economy, who is going to be left to buy IBM's products? It's essentially the Henry Ford problem all over again.
Right. Ford realized he had to pay his workers enough so they could actually afford to buy the cars they were building. AI doesn't buy cars. AI doesn't buy software subscriptions.
Precisely. And we are already seeing some very early tremors in the U.S. housing market that align with this fear. The source data points out that in Florida right now, house prices are actively falling. And there's a deeply disturbing spike in a very specific Google search term, help with mortgage.
Help with mortgage. Wow.
Yeah. That search volume is currently trending at levels we haven't seen since the 2008 financial crisis. That is a massive distress signal. It suggests that underneath all the strong economy headlines, average households are really struggling to keep up.
And then you have Jamie Dimon, the CEO of JP Morgan, who is effectively the most powerful banker on the planet, sounding the alarm. He's actively warning about a financial crisis and saying, quote, people are doing dumb things.
Yes, and he is specifically pointing his finger at the private credit bubble.
Break that down for us. What exactly is private credit?
It's lending that happens entirely outside of the traditional regulated banking system. So instead of a normal bank lending money to a company, a private equity firm lends the money directly. It has grown into a massive, multi-trillion-dollar industry.
And because it is private,
it's completely opaque. We don't really know how bad the bad loans are until they literally blow up in our faces. Dimon is suggesting that the combination of this massive shadow lending bubble and the incoming AI shift could be the ultimate trigger. If those private loans are based on business models that AI is about to completely disrupt, that whole pile of debt could turn toxic overnight.
So we have the visible system, the traditional banks, and the shadow system, private credit, both staring straight down the barrel of this AI transition. And speaking of shadow systems, that brings us perfectly to our third pillar, the hidden hands.
Now we're getting into the stuff that usually gets dismissed as pure conspiracy theory, at least until the massive lawsuits start flying.
We need to talk about Jane Street.
Jane Street. Just the name implies this quiet, leafy suburban road. But in reality, it is a financial Death Star.
For the listener who doesn't track all the Wall Street inside baseball, who exactly are they?
They are a quantitative trading firm. They are not a hedge fund. They don't manage your pension or your grandma's retirement. They are what's called a proprietary firm, meaning they trade exclusively with their own money. And they are massive. They pulled in $10 billion in trading revenue recently. That puts them right on par with the biggest trading desks at Goldman Sachs or JP Morgan.
But Goldman Sachs has regulators crawling all over them every single day.
Jane Street has virtually zero transparency requirements in comparison. They're a ghost in the machine. And recently, some absolutely explosive allegations have come out suggesting they aren't just trading the market, but actively moving it.
Let's start with the Terra Luna crash. For context, this was the big crypto disaster of 2022. Billions of dollars wiped out. The standard narrative was always that the algorithm just failed under pressure. But now, Terraform Labs, the company behind it, is actively suing Jane Street.
Right. The lawsuit alleges that the crash wasn't an accident at all. They claim Jane Street deliberately triggered the death spiral.
How do you even do that? How do you trigger a death spiral in a multi-billion-dollar asset?
The specific allegation is that Jane Street built up a massive position in UST, which was the stablecoin. Then, at a moment of extreme vulnerability, they executed a highly coordinated sell-off to intentionally drain the liquidity pool.
They just pulled the plug right out of the bathtub.
Yes. And once the price started to slip even a little bit, panic set in among retail investors. The algorithm tried to print more Luna tokens to fix the peg, which just caused hyperinflation. And while all this chaos was happening, the allegation is that Jane Street was aggressively shorting the asset, profiting massively all the way down.
It's basically the classic George Soros move when he broke the Bank of England, but done with supercomputers and algorithms in the crypto market.
That is the accusation. And the weird thing is, it doesn't stop with Terra. The crypto community has been tracking something else for a while now, something called the 10 a.m. rule with Bitcoin.
I found this part of the notes absolutely fascinating. Explain this pattern.
Traders noticed that for years, Bitcoin would very often take a massive dump at exactly 10:00 a.m. Eastern Time, just like clockwork.
Which is weird, right? Because markets are supposed to be random. They digest news constantly.
Exactly. If a massive price drop happens every single day at the exact same time, it is not a market. It is a program. The theory, and again, to be clear, these are just allegations right now, is that Jane Street was running a specific algorithm to suppress the price at that exact time.
But why? To what end? Why crash the price?
To liquidate retail investors. If you are a big player and you know a lot of regular people are betting on the price going up using leverage, you crash the price just enough to trigger their automatic stop losses. You wipe them out, force them to sell, and then you just buy back the coins cheaper. It's essentially a harvest.
But here is the real smoking gun, or at least the massive coincidence that has everyone putting on their tinfoil hats right now. The exact moment that lawsuit was filed regarding Terra Luna, what happened to the 10 a.m. rule?
It vanished. The pattern completely stopped.
That is highly suspicious.
It raises a massive structural question. Is the reason Bitcoin isn't sitting at $150,000 right now simply because one opaque entity has been using an algorithm to artificially cap the price?
It feeds directly back into that core theme of eroding trust. If the listener feels like the market is just rigged by a ghost in the machine, why even play? Why invest your hard-earned money?
And that exact question, why play this rigged game, is driving the final major shift we really need to discuss today. The global flight to hard assets, gold and silver.
But even there, even in the oldest money in the world, we see signs of manipulation. The source material details this bizarre event at the CME, the Chicago Mercantile Exchange.
Ah, yes, the glitch.
Yeah, gold and silver were breaking out. They were pushing hard past key resistance levels. All the technical analysis said it was skyrocket time. And suddenly, technical issues, all trading is halted.
And when it finally reopened, or right during that chaotic restart window, 160 million ounces of paper silver were dumped onto the market in 15 minutes.
160 million ounces in 15 minutes.
Just to put that in perspective for the listener, that is a highly significant chunk of the entire global annual production of silver traded in the time it takes you to drink a cup of coffee.
That is not a trader accidentally sneezing on the sell key. That is a financial nuke.
The expert analysis in our source material suggests this was a textbook synthetic delta dump.
Okay, jargon alert. Synthetic delta dump. Break that down for us.
Okay. Synthetic means it is not real metal. Nobody was actually loading physical bars of silver onto a truck to sell. They were selling paper contracts, which are just promises to sell silver. Delta dump implies a massive, coordinated flood of these paper contracts designed specifically to push the price down. It is essentially a giant wall of paper that says, you shall not pass this price level.
So it's pure price suppression via paper.
Yes, but, and this is the really big, but of the entire deep dive, the physical world is finally fighting back. We're seeing a massive geopolitical shift right now, specifically coming from India.
This part is huge, and I really feel like the Western media is completely sleeping on it.
They absolutely are. Look, India is a massive consumer of gold. Historically, everyone globally just used the LBMA price, the London Bullion Market Association, as the real price of gold.
But the London price is a paper price. It is based on trading those exact same contracts we just talked about.
Exactly. But India is now actively moving away from that London peg. They are establishing their own reference price based on the actual physical metal market in India. They are basically standing up and saying, we don't care what your paper contract says in London. This is what the actual metal costs to buy in Mumbai.
It is a full-blown revolt against the paper market. It's physical reality asserting dominance over financial fiction.
And the Indian regulator, SEBI, just changed the rules for their domestic investors, too. They completely opened the floodgates.
How so? What did they change?
Previously, there were really tight restrictions on how much gold standard investment funds could hold. Now, equity funds in India are allowed to hold up to 35% of their entire portfolio in gold and silver.
35%. That is a massive asset allocation. That represents billions and billions of dollars of potential buying pressure.
And the money is already moving. The flows into gold ETFs in India have spiked 900% since July alone. For the first time ever, more money is actively flowing into gold funds in India than into traditional stock market funds.
That is a total sea change in investor psychology. It is a massive vote of no confidence in the Western paper system. And it's not just India either. China is doing the exact same thing.
China's central bank has officially increased its physical gold reserves for 8 consecutive months now. It's up nearly 16%. And crucially, the premium on silver in China is currently higher than it is in the West.
Meaning silver physically costs more to buy in Shanghai than it does in New York.
Yes, and that proves that physical demand is outstripping supply. The arbitrage there implies that the paper price in the West is functionally fake, and the physical price in the East is the real market value. The West is trying to suppress the price with endless paper contracts, while the East is just quietly buying up all the actual metal.
But that eventually breaks, right? I mean, you literally run out of metal.
Eventually, yes. The paper game only works as long as people accept the paper. The second they demand physical delivery, the game ends.
Okay, so bringing this all together, we have the Netherlands warning us that government policy is fundamentally broken and IT systems are failing. We have St. Trinity warning us that AI is about to completely break the human income model and crash the banks. We have Jane Street potentially manipulating the digital crypto markets. And we have India and China saying, you know what, we're taking our ball and going home to physical gold.
It is a lot to process. It really feels like the end of an era.
It does. So let's get practical for a minute. Segment 6. Our source, Madelon Voss, shares her personal strategy for navigating this exact mess. She is staring at the same terrifying data we just went through. What is she actually doing with her money?
She advocates for what we typically call a barbell strategy in finance. Imagine a barbell with heavy weights on both ends, but absolutely nothing in the middle.
Okay, so extreme safety on one side and high risk on the other.
Exactly. On the safety side, she uses dollar cost averaging, or DCA, into a broad world ETF, specifically the MSCI world.
And she uses the platform Trade Republic for this, right? The goal is just smoothing out the volatility.
Yes. She notes that despite all the market dips and all the macroeconomic fear we just discussed, that specific strategy is actually up 15% over 2 years for her. It is the boring set it and forget it portion. It is essentially betting that somehow the global corporate machine will just keep chugging along.
But she also heavily plays the other side of the barbell, crypto.
Right. And for that, she looks at the repetition fractal cycle.
That sounds like something straight out of a quantum physics class.
It essentially is technical astrology for charts, but it clearly works for her strategy. She looks at historical market patterns to predict future bottoms. Her view is deeply contrarian. She argues you should buy when the RSI, the Relative Strength Index, is extremely low.
Basically, you buy when everyone else is bored, scared, or crying on social media.
Exactly.
Yeah.
She specifically mentions looking for a potential dip down to 50K for Bitcoin before the next major run-up. So she is not chasing the big green candles. She is patiently waiting for the red ones.
And finally, regarding those precious metals we just discussed, she has a very specific, unbreakable rule for that. Allocated storage.
This is critical for the listener to understand. If you buy gold through a bank or a trading app, you always need to ask, is it allocated or unallocated?
What is the actual difference in legal terms?
Unallocated gold means you just have a claim on the bank's general shared pool of gold. You are technically an unsecured creditor. If that bank goes bust, like we discussed in the AI mortgage scenario, you don't own a specific bar of gold. You just own an IOU from a dead bank. And that IOU might be totally worthless.
So you think you are sitting safe on physical gold, but you actually just own a paper promise from a bankrupt institution.
Correct. Allocated, on the other hand, means there is a specific physical bar with a specific serial number sitting in a vault, she prefers Switzerland, by the way, that legally belongs to you and only you. It is not on the bank's balance sheet. If the bank completely fails, the liquidators cannot touch your gold. It is your property.
That feels like the ultimate trust no one move.
In this specific macroeconomic environment, where tax authorities are completely failing and opaque algorithms are rigging prices, it's really just basic prudence.
So let's wrap this whole thing up. We have covered a massive amount of ground today. If you had to really synthesize this for the listener, what is the red thread connecting Dutch startup taxes, AI robots replacing workers, and Indian gold markets?
The red thread is the complete breakdown of our old social contracts.
Unpack that a bit.
Think about it. For decades, we trusted governments to tax fairly and efficiently. The Dutch Box 3 example shows that at us failing because of sheer administrative incompetence, we trusted the economy to provide steady wages in exchange for our productivity. AI threatens to completely break that link. We trusted financial markets to be fair and transparent. Jane Street and the CME glitch suggest they might actually be rigged against us.
So the global flight to gold or to Bitcoin or just getting your money out of a specific tax jurisdiction, it's all just a visceral reaction to that massive loss of trust.
Exactly. The system is incredibly fragile right now because it was built for a world that simply no longer exists. It was built for a world of manual labor, transparent pricing, and efficient paper-based government. That world is fading fast. The digital world is eating it alive.
It really leaves us with a provocative thought to end on. We talked extensively about the global intelligence crisis. If that Sint Trinity prediction actually comes true, if AI really does permanently break the link between human labor and economic value.
The real question becomes, who is the economy actually for in 2028?
Right.
Is it for the humans who can no longer qualify for basic loans because they don't have steady wages anymore? Or is it just for the algorithms that are generating all the massive corporate profit? If the banking system stops lending to people and only lends to corporate bots, do we even have a functioning society anymore? Or is it just a machine that hums to itself in an empty room?
It's a sobering question. Are we actively building a future where the economy booms on paper, but the actual people are completely left behind? And if the financial system becomes a closed loop of AI trading with AI, taxed by algorithms, where does human agency even fit in?
That is exactly the question we all need to be asking ourselves right now. And honestly, it makes buying a little physical allocated gold seem like the most rational thing in the world.
That is it for this deep dive. A massive amount to chew on today. Thank you so much for listening, and we'll catch you on the next one.
Stay curious.